Section 24, mortgage interest relief cap. By now, you may be panicking, you may be stressed out. You need to do something before this meteorite comes out and wipes your entire property portfolio business. I'm going to be talking about how this may be mitigated by simply refinancing your property investments. Stay tuned. So as this video explained, this is about refinancing your property investments. Now there may be some things you can do pretty quickly and simply by refinancing your property investments that could have a positive bearing on the impact of Section 24. So let's go into the slides now and see the details. So as we're going to go through now, we're talking about remortgaging your property portfolios. Why might you do that? Well, let's come on to that just a little later. But if you are going on this video for the first time and you're not quite sure how Section 24 mortgage interest relief cap affects you, then please do watch that video which is appearing just above my head. So before you go ahead and refinance your property investments, you do need to think carefully about whether that strategy is going to work for you. This video talks about Section 24 and the benefits refinancing will have, but I do ask you to watch this video which is appearing above my head, which gives you the other side, the downsides if you will, of refinancing your property investment. So please do watch that video, quite useful and hopefully some helpful tips as well. As I said, you can go onto government website again to look at Section 24, but stay tuned for this because I will give you an abbreviated version. There's a lot of details on HMRC's website and that could pretty much put you to sleep. So Section 24, we have to remember, is a compound effect. As Section 24 is going to be flowing through, we've got to bear in mind that mortgage interest rates are going to be increasing. And as a result, there's a lot more competition of mortgage providers and mortgage interest rates are going to be going up. So it could be a good time for you to fix in now some fixed rates over the next 5-6 years. So here then we have an example. We're going to be talking about the exact same property, but the only difference is the amount of mortgage that you may have it and the mortgage interest rate. So that's it. It's the same property in question. It's just going to be focusing on the different types of mortgages you may have. And the first one we're going to see is, we're just going to go through details here. Each one of these properties is £125,000 because it's the same property, right? We're just talking about the different scenarios that's going to play within. You've got the same deposits on these first two properties because we're going to have a 75% mortgage. So the amount of deposit, is £31,250 with a mortgage of £93,000. So ultimately you've got to look over here though, and the mortgage is 0% because we're going to have it as unencumbered. And then £125,000 worth of deposit. Now, you might be looking at this thinking, this guy's crazy. Why would you ever do this? Why would you have an unencumbered property? Well, okay, bear with me because I know the property mentors, the gurus and the educators out there, better educated than me in this kind of world of property investing. I get that. But my pure point is Section 24 mortgage interest relief cap. What used to be the norm of go for £25,000 in the first property, £25,000 second, £25,000 in the third, £25,000 in the fourth, gives you £100,000, right? So why not invest in 4 properties because you might get better capital appreciation on those 4 properties than one property at £100,000. And that makes sense, or it used to. But Section 24 does have a bearing and we need to go in the details. So please, please, please don't run off to the next video which talks about property investing with high leverage. I think we need to really understand the impact. So this particular property's got 4.5% mortgage interest rate and the second one's got 3.25. Why might that happen? Well, it's a good question because the first property is at 4.5%. Surely this doesn't make sense. Well, the second property is at 3.25%. What might have happened is that you get to a 2-year window where you get the best rates. The mortgage term then flicks over to 4.5%, but you've not done anything about it. In fact, you're probably too busy. You've not realized that the mortgage interest rate has triggered. You've ignored the letters and you just paid extra mortgage interest. So it can happen. And that's where I would say you just need to keep on top of it. Obviously, the third property has no mortgage at all, so we need to ignore that from that perspective. What's going to happen here is we're going to look at the real numbers. And all three properties, £8,000, because again, it's the same property. We're not talking about different properties, it's the same one. But the mortgage interest rate, because this is at 4.5%, you're paying more mortgage interest compared to this one. Now, the third property obviously has no mortgage, therefore has no mortgage interest cost. And then the other cost is £1,600 across the page, no real difference there. But you'll notice that the profit on the first property, because of their higher interest, is making less profit than all the properties put together. And I appreciate this one's got no mortgage. The return on investment's still not going to be as good, even though you're making absolute cash return of £6,400. But what does Section 24 do? Well, I'm glad you asked again. The first question is that you've got this £2,181 worth of profit. We'll stick with this property for now. But we've got to add back the mortgage interest cost of 4,219, which gives us the adjusted taxable profit of 6,400. You will notice that's what we're doing across the page, because Section 24 basically says I'm ignoring the whole mortgage interest cost. So you'd expect the taxable profit in the future to be the same, whether you had a mortgage or not. And that's exactly what's happening here. Now, the tax position is 40%, so we know we've got this 2560 across the page as well. There's no real difference. The slight difference here is that you get 20% tax reducer on the mortgage interest cost. So ultimately, you'd expect to get a better relief on the first property because you're paying more mortgage interest. It's at 4.5% versus 3.25%. So you'd expect to get more of that tax relief. But ultimately, you've got this tax now of $1,716. You're still sitting there thinking, well, surely this is a good thing for me, right? It's still less tax than these properties in question. Well, this is where the reality kicks in, sadly. We have to remember now that we've got this particular property that has got real profit of £2,181, but it's got a tax bill now of £1,716, which means it's got a tax of profits of 79%, which is a lot of money. And it means that the cash left in this particular property is $465. So you may be thinking that the first property was actually a good investment until you see these numbers. The second property, again, profit is better because the mortgage interest rate was lower, 3.25%. The net tax is 1951, which is slightly higher, but it's making a better profit. Now, look at this situation whereby you've got profits of 6,400 on an unencumbered property. The tax, yes, is higher at 2,560, but look at the percentage. It's much less than the first two properties because it doesn't have a mortgage in place. So could this be the end of mortgages? Could it be better for you to pay off your mortgages in full in order to have unencumbered properties? Now, I appreciate some of you will find this difficult with your financing. I get that. But at least what you should be doing is refinancing your properties to look at all your portfolio and say, where have I got the highest interest rates? Let's refinance those because it will save you a lot of tax and ultimately a lot of money to go with it. So I wanted to look at this position where you got the first property at £465 worth of profit. Remember, you got this 31,250 deposits going into the property. You're making now just 1.5%, which again, I know that people out there are thinking I was nuts earlier by saying you should not, you shouldn't have unencumbered properties. I get it from a property investment perspective, but look at the situation now. This property with no mortgage has got £3,840 worth of profits, and you've got to look at the return on investment of 3.1%. Okay, it's not, 15%. I get it. But you have to look at it and say, well, it's better than the 1.5%. Now, you may be in a situation you can't pay off your mortgages. Well, fine. But at least refinance your mortgages to get to this stage whereby you're increasing your return on investment. One, because you're going to be reducing your mortgage interest costs, which has got to be beneficial for you. And Section 24 as well is in the mix. It's going to be better for you. So refinancing your properties could be a good thing around Section 24. Paying off your mortgages, even better, but I understand that that may not be appropriate for you. Guys, there's a lot of detail going through here, but again, if you do have any questions at all, please do feel free to post those questions below this video, your comments box, and I will get back to you as soon as I can. If you like what we said to you about your property investments and how to make more money from them than ever before, then please go onto our website, www.optimizeaccountants.co.uk, and book a call with our business development manager, Jan Minty, and she'll be gladly to take a call at a time that's convenient for you. You can book online to talk to her. Secondly, if you are happy with your accountant and your accountancy provision, but you want a second opinion on your tax position, or indeed want to talk about your tax strategy, then why not book a call with me, the co-owner of Optimise Accountants? You can use the code YouTube25 to get 25% discount, and your call with me for 1 hour will be reduced from £400 to £300. Don't forget though, guys, if you have questions, you'll be able to upload your questions and documents ahead of the call, so I will be able to research your situation and the best solution for you before we even speak, and that might take up to an hour. So you'll be getting about 2-3 hours of my time to help you reduce your tax bill for the future. That's it for now, but my name is Misiewicz from Optimise Accountants. I shall see you on the next video. Bye bye.